Money doesn't stay still, it flows. Around the world, capital constantly moves toward places where opportunity, innovation, and growth potential are highest. Understanding this flow is the key to understanding how wealth is created on a global scale. In this video, we break down how capital moves, why it concentrates in certain industries and regions, and how you can position yourself where the money is flowing instead of where it is leaving. The flow of capital in the world is the underlying mechanism that determines where money accumulates, how economies grow, and why certain regions become centers of influence while others remain dependent on external financing. At its simplest, capital always moves toward perceived opportunity. But in reality, this movement is shaped by a complex interaction of interest rates, risk perception, geopolitical stability, technological innovation, institutional trust, and global financial architecture. Understanding this flow is essential to understanding modern wealth distribution at both national and individual levels. At the core of global capital movement is the search for return on investment. Investors, whether they are sovereign wealth funds, corporations, banks, or individuals, allocate capital to maximize returns relative to risk. This creates a constant global rebalancing where money shifts between asset classes, industries, and countries. When one region offers higher productivity or growth potential, capital begins to flow in, increasing investment, expanding businesses, and accelerating economic development. Conversely, when uncertainty rises, capital retreats towards safer jurisdictions, often concentrated in financially stable economies. A major driver of these movements is monetary policy, particularly the interest rate decisions of central banks such as the Federal Reserve or the European Central Bank. When interest rates rise in developed economies, global capital tends to flow inward because investors can obtain safer returns without taking excessive risk. When rates fall, capital often searches for higher yields in emerging markets, driving investment into riskier but higher growth regions. This dynamic creates cyclical waves of capital expansion and contraction across the global economy. Another powerful force shaping capital flow is institutional stability and global governance frameworks. Organizations such as the International Monetary Fund and the World Bank play a key role in stabilizing economies, providing liquidity support, and guiding structural reforms in developing nations. Their involvement often signals reduced risk for private investors, which can trigger increased capital inflows into struggling or transitioning economies. In this way, institutional credibility becomes a form of economic magnetism. Emerging markets play a critical role in the global flow of capital because they represent high-growth opportunities. Regions such as parts of Asia, Africa, and Latin America attract foreign direct investment when industrialization, infrastructure development, and demographic expansion create favorable conditions. However, these inflows are often volatile. When global conditions tighten or risk appetite declines, capital can exit just as quickly as it entered, leading to financial instability in these economies. This cyclical dependency on external capital is one of the defining characteristics of emerging market economies. Another structural element is the role of multinational corporations and global supply chains. Large companies act as major conduits of capital allocation by deciding where to build factories, hire labor, and invest in production capacity. Their decisions are influenced by labor costs, regulatory environments, tax structures, and logistical efficiency. As a result, capital flows not only through financial markets, but also through physical investment in infrastructure and production ecosystems. In recent decades, financial globalization has intensified inequality in capital distribution. Wealth tends to accumulate in financial hubs such as New York, London, and increasingly digital centers where investment infrastructure is highly developed. These hubs act as gravitational centers for global capital because they offer liquidity, expertise, and access to diverse investment instruments. Meanwhile, regions without strong financial infrastructure often struggle to retain or attract long-term capital, reinforcing global economic imbalances. The rise of digital assets and decentralized finance has introduced a new dimension to capital flow. While traditional systems rely on centralized institutions, blockchain-based systems allow capital to move across borders with reduced friction. This has created alternative pathways for investment and speculation, further increasing the speed at which capital can shift globally. However, this also introduces higher volatility and regulatory uncertainty, making capital allocation more dynamic but less predictable. Behavioral factors also play a significant role in capital movement. Investor psychology, herd behavior, and market sentiment often drive short-term flows that deviate from fundamental economic indicators. Fear and greed cycles can lead to rapid inflows during speculative booms and sudden outflows during crises. These behavioral dynamics amplify volatility and can sometimes override rational economic models in the short term. Ultimately, the flow of capital in the world is not random, but highly structured, even if it appears chaotic on the surface. It follows gradients of opportunity, stability, innovation, and trust. Money moves toward environments where it is expected to grow with the least acceptable level of risk. As global conditions change through policy shifts, technological advancement, or geopolitical realignment, the direction of these flows continuously adjusts. In essence, capital is constantly in motion, seeking efficiency. It rewards systems that are productive, predictable, and scalable, while withdrawing from environments that are unstable or inefficient. This continuous movement shapes global development patterns, determines economic winners and losers, and ultimately defines how wealth is distributed across the world. The flow of capital in the world is guided by a simple but powerful principle. Money consistently moves toward opportunity. Capital is never static. It is always searching for environments where it can grow, generate returns, and reduce risk. This movement shapes economies, industries, and even global power structures. At a macro level, capital flows across countries, markets, and sectors based on factors such as innovation, stability, infrastructure, and expected profitability. Investors and institutions continuously evaluate where their money can produce the highest efficiency and return. As a result, regions with strong economic policies, technological advancement, and stable governance tend to attract more investment, which further accelerates their growth. At a micro level, the same principle applies to businesses and individuals. Entrepreneurs who create clear opportunities, scalable models, and strong value propositions naturally attract funding, talent, and resources. Similarly, individuals who develop high-value skills and position themselves in growing industries are more likely to experience financial upward mobility. Ultimately, understanding the flow of capital reveals that wealth is not random. It concentrates where opportunity is clearly visible, efficiently structured, and consistently expanding. Those who learn to recognize or create opportunity become natural attractors of capital in an increasingly competitive global economy. Wealth is not random, it follows opportunity, timing, and positioning. Once you understand the flow of capital, you stop chasing money and start aligning with where it naturally goes. If you found this valuable, make sure to like, subscribe, and turn on notifications for more insights on money, economics, and wealth-building strategies in 2026.